Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, owner and founder of Menninger and Associates Financial Planning. I'm pleased again to have Brad Sorensen, chartered financial analyst and one of our CFA consulting team members who we deal with on a weekly basis from Cornerstone Portfolio Research. Brad, thank you again for joining us.
Glad to be here. Thanks for having me.
You're very welcome. It's always a pleasure to have you on board for the sake of our audience. Trying to get this now on a routine that we're doing this quarterly. And for the sake of the audience, this is being taped on July 10th. It's going to be airing on Wednesday, July 15th. And as we know, so many different things, particularly under the current administration, can change on a daily basis, right?
Definitely, yeah.
So in other words, it's always entirely possible that what we talk about today is old news by 5 days from now, particularly with the tariffs, because the tariffs were supposed to be July 9th, which was only 2 days ago. I said today's the 10th. Today's the 11th. Yeah, today's the 11th. So I guess it's going to air on the 16th, but be that as it may. So the long and short of it is that, we've got a few, normally you talk about the 800-pound gorilla in the room. Well, we got more than one gorilla in the room, and that lies with tariffs. We've got the wars going on, although they seem to be relatively insignificant relative to economic, and we could talk about that. We got the tariffs and the big, beautiful bill. So that in amongst all of the other things that are going on, the markets have reached new highs. And in the face of uncertainty, it's a little bit surprising, but then again, it's not. So anyway, Brad, kick me off. Where do you want to start? You want to start with the tariffs?
Yeah, I think we might as well start there. That's the biggest 800-pound gorilla we have right now.
So talk to me.
Well, yeah, it's injected. I think everybody knows this. It was April 9th, the Liberation Day, as the president would call it. That injected a lot of uncertainty into the market. And this is one thing that I want people to understand is that American businesses can deal with a lot of things. We've seen that over the past. They can adjust to many different circumstances, different administrations, different parties, the whole thing. What they have trouble doing is planning when they don't know the rules. And that's where we are kind of right now, that, as you said, there was these original tariffs, then there was a pause in the tariffs, then there was an extension of the pause of the tariffs, and now there's letters going out to countries saying, here's what we're going to charge you. And every morning right now, there's a new threat of, like this morning on the 11th, it's a threat to Canada that the United States is going to charge them 35%. The market seems to be getting used to the Trump way of doing things again, and viewing this all as a negotiation. But so they're not overreacting. Investors aren't overreacting anymore, really. But what happens is businesses have trouble planning for these things because they don't know what their cost structure will be if they have to hire more people, if they have to hire fewer people, if they have to adjust their supply chains, et cetera, et cetera. So that injects some measure of uncertainty in the economy and among business leaders.
Well, basically the long and short of it is the underlying value of a stock is its earnings and earnings growth, dividend and dividend growth. And the daily movements are the speculation of what its earnings or all those things are going to be. And when the CEOs don't even know what is going to happen, how in the world are the investors going to know, which just adds to the volatility?
Exactly. And you make the excellent point that I think a lot of people forget. It's like, why do we care about the tariffs? Why do we care about or not care about wars going on overseas? Why do we care about the big, beautiful bill? Well, as investors, we care about it ultimately because how does it flow through to earnings? What does it do to companies' earnings? Can they grow their earnings? And that goes from the cost and revenue side. Do we see a dramatic change in their cost structure, in their ability to gain revenue through consumer spending, those kind of things? So all of these, we pay attention to all of these things, not because it's a hobby of ours, it's because of how it flows through to earnings. That's ultimately what investors and what drives stock prices is the earnings estimates. And those have gotten very vague because companies just don't know what the impact of these tariffs are going to be.
Well, on that note, April was extraordinarily uncertain. Not that today is less uncertain. We're almost exactly 3 months away from the Liberation Day where the markets took a tank because of it. We've made that up and then some. Is there less uncertainty today?
According to the Federal Reserve, there is. So I'll believe them. They have 200 PhD economists on their staff. And I think there is that what we've learned, I think people had forgotten the original tariffs that people had forgotten, they were quite draconian. They were huge tariffs on every country in the world. And that was really just the opening shot. That's the way president does things. And now we're learning that. So what has happened is the range of possibilities the investors believe, and I think this is true, has been narrowed. We're not going to have 200% tariffs on every country in the world. We're not going to blow up every trade relationship. We're going to negotiate and come to agreements now. So that narrows the possibility that no tariffs, that's off the table, and extremely high tariffs, that's off the table. So it's just where in the middle do we land? And it's probably going to be a country by country thing. But as we've seen, generally, and this is a very rough number, but 10 to 50% is kind of where the trade deals that have been announced, the couple that have been announced, is generally what has been agreed upon. And the market can deal with that. So that's kind of what the market is starting to price in, is that 10 to 20% tariffs on most relationships in foreign countries.
How does that compare to what it used to be?
Well, that gets pretty complicated. There's different tariff agreements with every country, but much higher than it used to be. The United States, traditionally over the last 30 years, we'll say, has been a very low tariff country. And most countries know, and most economists would believe that, I'm not going to say it's not fair, but it's not equal. And we viewed us as a lot of administrations viewed us as the big economic power, and we can afford to pay some tariffs and help out these other countries and not charge tariffs themselves. And we tried to lead the way on free trade. That's been the American stance for quite a while. The current president came in, argued, obviously a lot of people agreed with him because he was elected, that the United States has been taken advantage of. And so we need to equal the playing field a little bit more. If you're going to charge Harley Davidson, like, just an example, this is the example that most people use. In Europe, they charge somewhere around 40 to 50% tariffs on Harley Davidson motorcycles coming in. So that increases the cost to Europeans of Harley David motorcycles to $80,000-$90,000. Well, that is really not competitive over there. But we allow European motorcycles into the United States traditionally with very low tariffs. So why is that fair to Harley Davidson, etc.? So that's kind of the process that we go through. But you can see that that's one manufacturer, one country versus another country. We have dozens of trading relationships, well, hundreds, but dozens that matter. And it takes time to get through these because there's nuances in every situation, whether it be agriculture, food products, legal issues, environmental standards, et cetera, unions, they all play into this. So it's hard to get trade deals done in a very quick time period. That's why, a 3-month pause clearly wasn't going to be enough. And now it's been extended further and will likely be extended further because trade deals take a while to get to.
Well, the biggest component of that 800-pound gorilla in all of the tariffs is obviously China, because China is the second largest economy in the world. They produce a lot of the goods that we bring in, and they're preventing us from sending goods out to them. Could you elaborate a little bit on the whole China trade? Because I think a lot of people don't really understand, why are we having such a problem with China? We had this problem with China pre-COVID, and I remember there was the trade problems again with Trump. And then subsequent to that, we came to the realization during COVID, holy cow, we're too reliant on China for goods and services. So do me, please, for the sake of the viewers, elaborate more on the trade relationship restrictions and everything associated with China.
Well, we could make 6 episodes on the relationship with China. There's so many details with that. But on a high-level view, the complications with China are that it's not just a trade relationship. There are security concerns as well. And that complicates the issues. Like you said, the worry was that we were relying too much on Chinese goods, especially in the rare earth, technology, semiconductor, those kind of things. Already there, we won't get into the United States Congress voted and the former president signed banning TikTok because it uses a Chinese algorithm that they believe, I think probably credibly, that the Chinese are using to spy on the United States. And so that throws a wrench into that as well. And they don't like us, we don't like them, but we need each other. So we have to have a trade relationship that benefits both parties, and that takes a while to get to. Already, we've seen that they are willing to negotiate, and we're willing to negotiate with them because there was a lot of back and forth, tit for tat. I'm going to raise your tariff. You're going to raise. They both raised tariffs to 150%. That was ridiculous. That has backed off. They've been talking. There's rumors this morning that Premier Xi of China and President Trump are going to meet. That would be a positive thing. And they came to an agreement. We stopped shipping semiconductors to China, and they stopped shipping rare earth metals to the United States. That has been reversed. So there is a thawing of the relations that had gotten pretty bad. But where the trade relationship ends up, for example, there was a de minimis exception where anything under $600 from China wasn't tariffed into the United States. That's been eliminated. So there are just so many products that come from China, it's going to take a while to get to a deal with them.
Interesting. So now the reference of the trade problems that we had, I think it was 2018, that are occurring again, and the tariffs is the fear of inflation, which can be, well, if we're increasing the price by 20%, that means it's going to increase the price 20% across the board to Americans, and therefore inflation runs out of control. And then maybe not out of control. And then secondarily is, just like we ran into a supply chain issue, supply chain issues also can be inflationary, because if there's not enough around, then you're going to have to pay more to get the ones. Now, how much of that is real and how much of that is, I don't want to say fabricated, but feared?
Well, I think that's been one of the most overhyped stories that's been out there, is that A leads to B leads to C, that or raising of tariffs leads to an equal raising of inflation, which leads to an economic calamity. Well, I don't think that's true, and we've already seen that. Like I said, American businesses can adjust to a lot of things, and we've already seen them do that with tariffs, because there has been a raise in the tariffs to about 10%, so they have had to deal with that. And what we've seen is other countries, as the president said, they've absorbed some of that. Companies' margins has absorbed some of that. So actually what we've seen so far, and I'm not saying this is going to continue forever, but we've seen inflation come down as measured by core CPI over the course of the last few months, indicating that we haven't seen the inflationary pressures. And what we have seen is margins go, because they were pretty wide. Companies, and people won't be surprised to hear this, they didn't roll back prices aggressively after the supply chains got fixed after COVID. So they had some room in their margins to compress those a little bit and eat a little of the cost and not pass that on to consumers in order to maintain the demand.
Well, it's good.
But ultimately, like you said, that does impact earnings, and that's what matters to companies. So we'll see how much impact, and we're going to get to Q2, second quarter earnings season starts next week in earnest. And that's when we'll start to see, are they really seeing an impact, or is it really negligible because they have different suppliers? And like you said, since 2018, companies have diversified their supply chains to other places than China and multiple countries. That helps to mitigate some of that tariff thing, even though most countries do have tariffs, there are different levels, so that helps. And even some manufacturing has been brought back to the United States, although not in great scale yet.
Well, good. You know what? So we'll let the tariffs go for now, and we'll pick up at the end. We're going to take a short break here. So stay tuned. We'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger & Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we're making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained. And I'm still here with Brad Sorensen, CFA. And in the first segment, we were talking mostly about the tariffs. Now, I guess we'll talk about the big, beautiful bill. Now, I'll talk about it from my perspective, and then you can pick it up from an economic perspective. And from my perspective, because, we're financial planners and we heavily emphasize tax planning, when I look at the big, beautiful bill, what I see is the bulk of it was very simply just extending the tax laws. And then above and beyond that, they made a few tweaks to the tax law changes. And from what I've observed so far, everything has been a tax cut. Now, not a lot, but there are tax cuts in there, whether it be the SALT, which is the state and local income tax deductions that they've increased to allow for itemizing on your tax returns. They've increased the standard deduction for age 65 and over who are collecting Social Security. That was sort of the offset to no tax on Social Security. They have some nuances, but they're talking about the no tips on wages and overtime, lots of restrictions on that. One of the things that I have found is that, because I'm creative and sneaky, is I look for ways to capitalize on it. And the practicality of the matter is there's not going to be a lot of, I don't want to say fraud, but a lot of ways to manipulate that, and that it's really helping, from what I see, the middle class, the middle and lower class. And then they threw in some other pork. But, from my perspective, there really wasn't much of a change. But Brad, can you elaborate on it more from an economic perspective, or anything else that you want to add to it?
Sure. I think the headline, and people may wonder, Mike calls it the big, beautiful bill. And when we say that, it's like we support or whatever that is the actual name of it in Congress. That was the big, beautiful bill. I looked into that because I didn't love calling it that, but that's what the official name is. So that's why we call it that. And really the headline was, and this kind of got shoved under the table because of all the other arguments, but there would have been, it eliminated a potential economic problem in that the tax cuts from the first Trump administration were scheduled to end at the end of this year. And if that had happened, that would have been a big tax raise for everybody. And that probably would have caused at least an economic bump, if not worse. And so that in and of itself is really the headline from this that's kind of gotten buried, is that we extended those tax cuts from the first Trump administration. The additional tax cuts don't really matter. The second big thing, economically, the second major thing is the deficit, and that is still concerning. But we've seen that investors, when the House first passed the big beautiful bill, markets reacted a little bit. You could tell, especially the fixed income markets, treasury yields went up. There was some pushing back among bond investors that, hey, these deficits are getting too high. But we've seen over the past few months become a little more comfort with it, and yields have gone back down. So what we, I wish I could say something else, but what we say is deficits don't matter until they matter. There will be a point when they do. It just doesn't seem like this is going to be that point, at least right now.
Well, that is what concerns me, but not as much for me, but it is for my children and grandchildren, because that train's got to come to an end at some point in time. And I always thought that it was going to be in the form of raising taxes or what have you, because we just can't run this deficit forever, and we can't continue to carry this national debt, because this national debt has now reached, I think, 14% or 16, I forgot, I think it's 14% of our national budget is paying just the interest on our debt. And it was only in 2020 that it was 6%. And, it's like, think of a household. If all of a sudden you're straddled with too much debt, it's tough to survive when you're trying to make debt payments. And that's what concerns me. And, it's very simple. Either make more money or spend less. And making more is raising taxes. Spending less, the Congress has demonstrated its inability to spend less, and they like to spend more. And and
there's three ways, and none of them are great. That's where you get a little bit concerned. Like you mentioned, the first two, and there's also, and other countries have tried this and it hasn't worked out well, but you can inflate your way out of it, and you can print money and lower interest rates. And that's what, President Trump's been arguing, to lower interest rates so the interest rate cost is lower. But what that leads to is inflation. And we've seen that can be equally or more damaging than the deficit. So there's not a great answer here. So we'll just have to see what happens. But it's probably some combination of all of those things. And hopefully what you can do is grow your way out of it. If U.S. economic growth can sustain itself, then we can slightly reduce spending, slightly raise taxes, and slowly get back to sanity. Whether that will happen or not, I don't know.
Yeah, sanity is an interesting word. So, the thing that I've always commented is that if we increased our exports, then that would just effectively bring more money back into the country, which should hopefully improve our GDP and, quite frankly, help us pay down debt or at least close the deficit. Is that a fair assessment?
Yeah, at the margins, that would. But the trade market, that's the other thing. The exports minus imports component of GDP is relatively low. So, like, even right now, the tariffs are bringing in a substantially more amount, but in the grand scheme of things, it's really a drop in the bucket of what our deficit is. So yeah, it can help, but it's nowhere near enough to really make a difference in that deficit.
Okay. So lastly, I know you wanted to talk about where we are today, particularly with the labor market, credit spreads, consumer and business confidence. Let's talk about that and see where we are today. And then the next episode will be looking forward.
Sure. But where we are today is still in an uncertain, but not quite as uncertain. And like you said, where we are is at record highs in the indexes. And that's kind of hard to believe. What just happened, this will get a little statistically wonky, but it was a 4 sigma event that we went from the lows to the highs in a 2-month period. That is considered a four sigma event, which just means that it's a very low chance of happening, a less than 1% chance of that happening based on statistics. So you're living through what you've just seen over the past couple of months is a very rare occurrence to see a snapback like we've seen. And this is why, and they get a lot of headlines, but this is why I don't pay attention much to confidence surveys. Consumer confidence crashed over the past couple of months, although it's rebounded over the last month. Business confidence went down. But what you look at is the actual data. Does that mean that consumers are stopping spending? Well, no. Consumers don't stop spending when they feel bad. They still spend. They spend until they can't anymore. And as long as the employment market holds up, they can spend money. And the employment market's held up really well, with employment in the 4.2% range, which historically is very low, and we're still adding jobs according to the Labor Department. So that all augurs that our economy is still holding up well, despite the uncertainty surrounding the tariffs. So we're not falling off a cliff. Things aren't turning into Armageddon. It's just a bump in the road at this point, and really the ultimate arbiter of this is the stock market, and it seems to be not all that concerned at this point.
And the stock market is a leading indicator. And for the sake of the viewers, when you referenced 4.2%, that is the unemployment rate. And isn't it anything 5% is considered full employment?
Yeah, that's starting to be debated because we haven't seen 5% in a while, but traditionally, back when I was in grad school, that was considered, yes, that's the natural unemployment rate that you get just because there's people quitting and moving jobs and changing jobs and for lifestyle reasons, whatever. There's always going to be this 5% natural unemployment, but we've seen that maybe lower, but regardless, 4.2% is low.
And it's been low, and it's been low for a lot of years. So with all the obviously it went up, it spiked with COVID. But ever since
we always have
COVID
to say ex-COVID because that kind of skews all the numbers.
Right, but it's back to where it had historically been, and that is a real good indicator of the health of the U.S. economy. What else can you say? Now, there were a couple of questions that I had that were, I guess, little layman questions. You know, they talk about government layoffs, okay? What impact has that had? And then more recently, because of the deportations and the fear, a lot of immigrants, shall I say, illegals who live in the country who have been employed and they've been working, doing whatever it is they're doing, suddenly are fearing that someone's going to show up at the job site and haul them away and send them back to their own country. How much of an impact has that had on the labor market?
Well, to this point, it's been negligible, but they're still going on. For example, the first point with the government layoffs, the administration was blocked legally from doing a lot of that because of a court injunction. The Supreme Court just lifted that and said the president does actually have a lot of authority, incidentally, not to fire Federal Reserve officials, but to lay off a lot of other employees, because if you've ever heard, they largely serve at the pleasure of the president. He appoints them so he can fire them. That's kind of the Supreme Court's decision. So that we may see more of that going forward, but ultimately, any government layoffs that we see, you're going to need a certain number just to maintain our bureaucratic governance. So it's going to be, in the vast United States employment picture, a very small number. Even in the government employment picture, it's probably going to be a pretty low percentage. So I don't know that it'll have a huge impact. As far as the immigration, that's where we're just starting to see. For example, we just saw what's called the JOLT survey, which is jobs opening and labor turnover survey, very roll off the tongue. But we saw job openings surprisingly jump And that was largely attributed to those jobs that you mentioned that immigrants had been filling, that for whatever reason, either fear or deportation, they're not going to anymore. So companies are having to reopen those jobs. And now we'll see what the impact of that is. If domestic workers take those jobs, or if they have to raise wages to get people to take those jobs, that's the uncertainty. The other uncertainty that people are dealing with is what will be the impact of that. That could be more inflationary than the tariffs, but we just don't know right now.
Okay. Is there anything else that you'd like to add before we wrap up this episode on the sort of current economic conditions, so to speak?
The only thing I would like to add is that when you hear reports out there, just take them with a grain of salt. The United States economy is strong and can overcome a lot of things. And there are a lot of cross currents here. And depending on who you listen to, you'll hear the bad ones or just the good ones. But they kind of mesh together to make a neutral pot where still the economy chugs along at a pretty good pace, somewhere around 2 to 3% growth. Not stellar, but good enough. So we're not falling off a cliff yet. We're not off to the races. That kind of eliminates the two extremes that people have talked about. But we're good, and we're looking forward to earnings season and trying to get some more insight from companies about where we really stand.
Well, that's a good way to finish off, because of the fact that we're going to talk on our next episode about moving forward and where do you start moving forward with earnings. So, Brad, thank you very much. Hope everybody enjoyed having Brad, and we'll get to see him again on next week's episode of Financial Planning Explained. Thank you for joining. I hope you have a wonderful day. Thank you for watching this episode of Financial Planning Explained. We strive to provide an educational experience for all of our viewers, and what we struggle with at times is topics. So if there's an idea or a topic that you would like for us to discuss on a future episode, please email us at admin@maaplanning.com, or you may enter it on the Contact Us page on our website at www.maaplanning.com. Thank you in advance for participating and helping make our show successful.